Thank you, Upstart, for sponsoring this video. Your 20s are an exciting time, whether you're living by yourself for the first time, moving across the country, or starting a new job. There's new opportunities everywhere. But with those new opportunities come new expenses. And in a time in our lives when we're focused on building our new careers and new friendships, our finances often take a back seat. One of the first post-grad realities you'll likely be hit with is student debt. For you, maybe it's not student debt specifically, maybe it's credit card debt or a new car loan, but regardless, the average American household is $67,000 in debt, and many don't realize that holding onto that debt is actually costing them more than they think. You see, when you take out a loan or carry over a credit card balance, you start owing something called interest. This is additional money that you have to pay on top of the money that you already owe. But it's not just a set amount. Interest compounds over time. So when you delay paying off debt, or even worse, start missing payments, that interest keeps compounding, meaning that you'll owe even more money. Not all debt is bad debt, but what you want to look for is debt that you have that has a high interest rate. Any interest rate that's above around 4 to 5% is usually considered pretty high and is something that you may want to consider paying off. So what we're usually talking about here is probably student loans, car loans, credit card debt. I've heard of people having student loans with interest rates that are anywhere between like 2% and 9%, so some of those aren't as bad as others, but with credit cards, many times the interest rates on those can be as high as 20 or 25%. Everyone is going to have different debt amounts, different interest rates, and different realistic timeframes that they can actually pay off that debt. So instead of having an overgeneralized goal of like pay off all your debt in 3 years, I'm going to say that the goal here is to have a plan for your debt. Add up all of that debt that you have, figure out the interest rates on each loan, Google an online calculator, and figure out the exact date that you would be debt-free if you made all of your payments on time. If you need to figure out ways to consolidate debt or lower those interest rates on any mortgages or credit cards or other loans that you have, you need to start doing that research. And today's sponsor may actually be helpful for you. So many Americans experienced financial hardship in the last year, and Upstart can help you get your footing and get things back on track. Whether it's paying off credit cards or consolidating high interest debt, over 500,000 people have used Upstart to get one fixed monthly payment. Upstart is a lending platform that knows you're more than just your credit score and is expanding access to affordable credit. Unlike other lenders, Upstart considers your income and current employment to find you a smarter rate for your loan. With a 5-minute online rate check, you can see your rate upfront for loans between $1,000 to $50,000. And you can receive those funds as fast as 1 business day after accepting your loan. Find out how Upstart can help lower your monthly payments today when you go to upstart.com/Arvibell. That's upstart.com/Arvibell. If you decide to use Upstart, don't forget to use our URL to let them know that we sent you. Knocking out that debt is one of the best things that you can do to start building a more solid foundation for yourself and to feel a bit more confident when you are saving money in the future. No one that I know at least likes owing anyone else money, so the faster that you can pay off that high interest debt, the easier it will be to start saving your money towards other goals in the future. With all of that talk about debt, credit cards can seem a little bit intimidating or even like a stupid idea, but in most cases, if you ever plan on buying a house, a car, or even renting an apartment by yourself, you will need to have a credit score. So our next goal is to build or fix your credit. A credit score is basically just a rating that lenders give you whenever you have a credit card or a loan. That rating lets lenders and credit card companies know how responsible you are at borrowing money and actually paying it back. If you have a low credit score, it's usually going to be incredibly hard to get any new credit cards or loans, or they'll give you an extremely bad or extremely high interest rate. Even worse, it's possible that you can be denied entirely from getting a home loan or from being accepted on an apartment application. If you have a high credit score, it's going to be a lot easier to get those new loans and credit cards and to get approved for things like mortgages and on apartments. So your credit score is really based on 5 things. If you make payments on time, which you always want to be doing that, how much of your credit line you're using, spending, and they usually like to see that under 30%, so maxing out your cards every month isn't a good look. How long you've had your lines of credit, which is why you'll hear people say not to close old credit cards. They'll also look at your mix of credit, which means the different types of credit that you have. So again, for example, student loans, home loans, and credit cards are all different lines of credit. And finally, they'll look at your recent applications. You don't want to apply to too many loans or credit cards too fast. It's usually better to wait somewhere around 6 to 8 months between applying for different credit cards. If you're well into your 20s and you don't have a credit score, or even if you're later in life, it's not too late to start building one. Or if you have a bad credit score, it's never too late to start fixing it. Over half of Americans have less than $5,000 saved, and about a third have less than $1,000 saved. This is a statistic that you do not want to be a part of. It's always good to have a safety net and money set aside in case anything goes wrong. And if there's anything that we've learned from the last 2 years, it's that everything can go wrong all at the same time very quickly. You could lose your job, or your entire industry could be shut down by a global pandemic. You just never really know. So it's always good to have that money set aside. So in your 20s or even in your 30s, it's a good idea to build up an emergency fund of 3 to 6 months of your regular expenses to set that money aside and to not touch it unless it is truly an emergency. Simultaneously, one of the easiest and hardest things to do in your 20s is to increase your income. It's hard getting your feet off of the ground, but if you can maximize your time, it's one of the best opportunities that you have in your life to really grow exponentially in your career and increase your income. Now, increasing your income doesn't have to be just asking for a raise at your 9-to-5 job. Think about ways that you could create a second income source for yourself, learn a high income skill, or maybe even switch jobs every couple of years in order to get a higher paying position. Increasing your income now and using that money to invest in your future is going to put you so far ahead. It's likely that you have less responsibilities and more free time now than you ever will in the future, so the sooner that you can increase your income, the more likely you'll be able to actually take advantage of opportunities that pop up later in life. And of course, if you're happy with where you're at, that's totally fine too. You don't always have to chase more and more income. It's just important that you aren't becoming complacent with a spot that you don't actually want to be in. As far as saving money in your 20s, this can be one of the biggest challenges. Between going out with friends, ordering Postmates, and paying rent, it can be hard to keep track of where your paycheck is actually going. The 3 biggest expenses that Americans have are, not surprisingly, housing, food, and transportation. So if you can reduce or even eliminate expenses in any of these categories, you'll save so much money over the course of your 20s. So let's look at a couple of ways to actually do that for each of these categories. For housing, we have house hacking. House hacking is essentially the concept of buying a house or a duplex and renting out the other side or other rooms in your house to cover the cost of the mortgage, which essentially means that you are getting to live there for free. Of course, not everyone is going to be able to buy a house in their 20s, so a good second option is to live at home for a couple of years if you're able to, then move out and live with roommates. Sharing household expenses with other people is always going to reduce those costs. Reducing expenses on food can be a little bit harder, but can still definitely be done. It could be as simple as driving an extra mile down the road to go to a cheaper grocery store, or just downloading grocery stores' apps to be a part of their digital coupon and loyalty programs. For a month, try keeping track of how much food you're buying, how much you're actually using, and how much you end up throwing away. Americans tend to throw out a lot more food than we think we do, so a simple solution for reducing some of those food expenses would be to buy only exactly what you need. In addition to that, try keeping track of how much extra you're spending by ordering food through apps like Postmates or Uber Eats. You may already have a pretty good idea of how much you spend monthly on food delivery, but it can make you feel a little bit differently when you actually break it down and look at how much of that money is going to the delivery app and how much of that money is actually going towards your food. As for eating at restaurants, hopefully restaurants are consistently a thing again, but just make sure that you're not throwing money out the window, going out too often, or trying to make up for the last year and a half of not really being able to go to restaurants with people. Transportation. Love it or hate it, you've got to go places, but the key is that you don't have to go places in a Mercedes. A used Honda Civic or the subway will work just fine, and you probably don't really need to Uber 2 blocks down the street. Of course, take an Uber when you actually need to, but if you're using multiple rideshare apps multiple times a day and you have other modes of transportation, those costs can really start to add up. Depending on where you live, you may be able to completely forego the expensive cost of owning a car, having car maintenance, car insurance, and all of the general headaches that come with a vehicle. In cities like New York and DC, from a cost standpoint, it probably makes more sense just to use the public transportation that's available, and usually in these cities, they have some sort of monthly passes that you can buy so that you're getting a better deal on those public transportation options. Unfortunately, in most US cities, you aren't going to have great public transit options. Try getting around Los Angeles or Houston without a car, and it's pretty much not going to happen. The good news though is that you can probably find a used car for like half the price of a new one. The thing about new cars is that one, yes, they're very expensive, but two, they also depreciate really quickly, meaning that they lose their value really fast. As soon as you drive a new car off of the lot, it's already going to be worth less than what you just bought it for. So finding those used options, if they're available, can be a great way to save money. Even though in your 20s retirement seems like it's a long time away, the sooner you actually start saving for retirement, the sooner you'll be able to retire. Learning about investing, whether or not the end goal is retirement, is so important for your 20s. The sooner you start learning about investing, the more money that you could potentially end up with. It's similar to how interest on a bank account works, but at a bigger scale. Over time, the money that you invest can earn you more money, which in turn can earn you even more money, and it has the potential to continue snowballing into an amount that's much greater than the initial amount that you actually put in. I have another video about where to invest your first $1,000 that'll give you an easy place to start, but remember that even though learning about all of this is daunting, Google and YouTube are always here to help you, and if you're investing in like a 401k through your employer, your HR department is also always there to help you. That's literally their job, so definitely ask them any questions that you have if you are using that employer 401k. There's one thing that we left out, and that's actually having fun. So set a few major and minor financial goals that you think are fun, that you actually want to achieve, and track your progress on them. This can be anything from saving for a down payment on a house, saving for a wedding or a vacation. Maybe you have a goal of retiring early. Whatever it is, set that goal and actually track your progress as you start saving and investing money towards whatever that goal is. Everyone is starting from a different place and has a different end goal in mind with their money, and what you're doing probably isn't going to look exactly the same as what your friend or your brother is doing, but as long as it's working for you and you're reaching the goals that you want to reach, that is all that really matters. Thank you again to Upstart for sponsoring this video. If you do want to check them out, be sure to click that link in the description or go to upstart.com/arvabell, and I will see you guys in the next one.